Oh, yeah. It's another WTF, but it's not just another WTF. It's another year. Welcome to the new year. Happy New Year to everybody. It's 2025. Kind of interesting that the WTF fell on the first day of the new year. I was pretty honored to be able to do this show and kind of go live. I'll probably be alone. Everybody else is taking the day off, but I am here in the office doing my thing. I don't know how many people we're actually going to get today, but you know what? There is a lot to cover. December was not a good month for the markets. It wasn't a Santa Claus rally. Matter of fact, in December, the Dow tumbled 260 points for a 9-day losing streak, its longest since 1978. Futures are pointing down today. The markets were down the other day. It's definitely setting up for 2025 to be an interesting year. And we're going to talk about that. We're going to talk about the attacks that the U.S. is right now doing in Yemen. We're going to talk about a whole bunch of stuff in the news. We'll be right back after this. All right. It's another WTF. What the F happened? And it is the first day of the new year, 2025. So I am honored to be able to host the show today, to kind of be able to put this thing on. Most people are still in bed because they went out last night, where I did not. I barely missed the ball drop, but it really wasn't all that exciting, and hey, plenty more ball drops to see, plenty more New Year's to come. I like to call it is the New Year morning. That's what I like. I got up really early this morning, fighting a little bit of a cold, trying to kind of get over it. So you know what? I figured, what the hell? Let's go on with the show and do it. So let's dive right in. Hopefully all of you are doing well. Happy New Year. Good morning. All right. So in the news, top line right now, Yahoo Finance, we got Jim Paulson coming on saying a stock correction looms as recession fears will resurface in 2025. So listen, here's the good news. If any of you were in the S&P 500, I believe the S&P 500 finished up somewhere around 23 to 25%. Woo! You guys crushed it. But any of you that were in bonds, you crushed it there too, because bonds did well. The yields have been high. You've been getting anywhere between 4 and 5%. So hand clap to that. Doesn't matter. You've been doing well. And any of you that are doing the infinite banking concepts, listen, you're crushing it, because if any of you are paying off debt using your infinite banking system, the debts that you're paying off, just take the interest rate you were paying to the bank. That's the interest rate you're recycling and recapturing. So you're doing better than everybody because you're not taking on any risk. Now, as you all know, 2024 was a year for Bitcoin. It was the strongest asset class in 2024. I can't remember what the return was, something like 300% you would have made if you had bought Bitcoin at the beginning of the year, 2024, around $40,000, and you would have held it through to the end of the year. It would have been like a 300-point increase, somewhere around $97,000 is what it grew to. But here's the difference. And there was a beautiful article. I don't know if I'll be able to find it here. Let's see if I can get it up. But there was a beautiful article that was put out about Bitcoin and how it was the year's best asset. Here we go. Right on CNBC. Bitcoin was the best investment of 2024, but not without its usual volatility. There was so much volatility. It was up, it was down, it was up. You need literally big cojones to be able to weather the storm of the Bitcoin ups and downs. But does Bitcoin have a future? Well, yeah, probably. Actually, I was off. So right here, Bitcoin versus everybody else, 2024. Let me show this to all of you. I'll just throw it up on the screen so you can see what I'm looking at here. There we go. So this is what we're looking at. Hopefully you can see that. Looks like Bitcoin 124.8, NASDAQ 30%, gold 26.8. Now that's interesting. Gold is a very defensive position, more of just a store of wealth, if you will. S&P 500 24.2%. Woohoo! Dow Jones 13.3, the Russell coming in at 10.6. Oil down a little bit, but that's probably good for most of you because if oil's down, the gas pumps are a little bit cheaper. And then you've got TLT, which I threw in there, which was a negative 10.8, but that's good because what we were doing with TLT, which is it's 20 plus year treasury bonds, we were buying. And you don't want to buy when it's up 24%. You want to buy low. And how many of you can repeat that? Sell high, right? Buy low, sell high, and don't lose money. But if you do 1 and 2, you can't lose because you don't lose money when you buy low and you sell high. But we seem to have a disconnect with that because people love to buy high. I mean, Bitcoin's a perfect example. There's so much hype right now on Bitcoin and cryptos. Everybody's plowing into it. There's a bunch of ETFs that came out showing it, so a lot of people are just jumping into it. But I would argue, listen, I think Bitcoin will go higher, but I think it will be a rough road. And if any of you were paying attention at the end of December when the stock market was going down, what was Bitcoin doing? Going down, because Bitcoin got up to, I believe, around 107, and then it finished up. I don't know where it's at today, but let's just call it 97, 94,000. That's a strong pullback. But why did it pull back? Well, because the stock market pulled back, or I don't know. They're correlated, so one is following the other. I don't yet really know which one is the leader in the pack. I would assume it's the broad-based indexes more so than Bitcoin, just because they're larger. However, Bitcoin's all the rage. So you just got to look at things and you got to say, do you want to buy the thing that's high or do you want to buy the stuff that's low? And low is long-term treasuries. And why do we buy long-term treasuries? Well, number one, they pay a pretty good yield. Number two, they're guaranteed by the full faith and credit of the United States government. And number three, well, I can show you a chart. They are priced really good to buy. You can buy them very low, and you can buy them low because of everything that's going on, the fear in the near term in the markets. And just like Paulson said there, like I was reading to you, he was saying there is certainly something going on in 2025, and he's thinking it's going to be a stock correction. Now, if you don't know who Jim Paulson is, you should look him up. He's definitely got a big name in the Wall Street world, and he's just going through saying the economic momentum wavers next year. Recession fear will trigger a market pullback. Some of you are asking probably, well, what would that pullback look like? That's almost impossible. Nobody can predict that. You can't time the market and you can't really predict what the market's going to do. He is saying probably expect somewhere between a 10 and 15% pullback. There are other economists that I follow that are actually saying that it's going to be a stronger and deeper pullback, up to 50%. But that won't probably be now because of the election and everything going on until later 2025 before you start to see that. So it's definitely not going to be the glory days of 2024 and 2023 where the markets just were bull runs going up, up, up. But here's the problem. I've said this a lot, and believe me, please give me your opinions. I'm going to come over to your questions. Like I said, we'll probably have a smaller audience, being that most people are probably still sleeping off the hangover from the New Year party. But I want to go over here to Jay Strat. What's the yield on long-term treasuries? Well, Jay, I'm glad you asked that question because I'll show you right now. Let's see, long-term treasury yields. I had this up today. It's probably on one of my tabs, but this is pretty easy. So right now, if you owned 30-year treasury bonds, you're looking at 4.78%. Now, just because it's a 30-year treasury, that's the duration, that doesn't mean you need to hold it for 30 years. Like I own lots of long-term treasuries. I won't hold them to duration. I won't hold them to maturity. I'm just going to ride the price wave up because when the markets go down and interest rates keep going down, which the Fed has clearly indicated, Jerome Powell has clearly indicated that the path for interest rates is down. So a lot of you are thinking, well, yeah, the interest rates are going down, but the treasury bond prices are not going up yet. There's a whole story with that, and you just got to wait it out and be patient because they will. We just haven't seen the fallout. And partly because it was the end of the year and hey, everybody was waiting for the Santa Claus rally, which, well, didn't come. Sorry about your luck. But nonetheless, it was a good year in the market. So if you're looking for any of the other ones, 20-year bonds, let's give that one 4.86% yield. And then 10-year treasury bonds, 4.55. And you can just go to the U.S. Department of Treasury.gov and that will show you all these yields, and you can just pull them up, look at them, do whatever you want. But pretty easy to find those yields if you just look for it. All right, let's keep going here. What else do we got? Any other questions? Free fall for Bitcoin. Yeah, I agree, Dexter. I think it's definitely going to be a free fall for not just Bitcoin, but also the markets. I love what Bitcoin does. I love the problem it solves, but more specifically, I love blockchain. I see a huge future for blockchain, but Bitcoin is just a component of this, right? You got to read Inventing Bitcoin, which is that book does a really good job of explaining what problem Bitcoin solves. Now, here's a big headwind that I want all of you to just consider and just think about. Now, this is not today. We're probably 5 years away from this threat or this problem, and I'm sure they'll figure it out. But it's just something I read about that I thought was interesting is quantum computing. Maybe you've studied it, maybe you've looked into it. Quantum computing. The technology of quantum computing is beyond anything you can comprehend. But literally, how it stands today, the blockchain and Bitcoin, right now, the way that it works, if quantum computing was here today, and if it actually worked today, they'd be able to hack and undo the security measures that are, found right now in blockchain and in Bitcoin. Literally, people could go on and not everybody, but if people don't know what they're doing, they could steal your Bitcoin. So that is way off. 5 years into the future is what the best guess would be for quantum computing. But just planting the seed in your mind. It's 2025. It's a new year. Who knows? Keep that one in the back of your mind. Quantum computing is definitely something that we all need to consider in the next 3 to 5 years. And it definitely will pose lots of problems for Bitcoin and blockchain and the securities of how that works, because literally with enough computing power, they can undo it. Right now, with today's computing, it was said that it would take, well, as much time as the universe took to create, I think is what it said, for current computers to literally hack the blockchain. And I'm saying that wrong. It would take that long, but with quantum computing, could be hours. Anyway, just interesting stuff, useless knowledge. But let's get into another thing. I just found this today. The U.S. strikes Houthi targets in Yemen after American warships attacked. So obviously, no secret to any of you, the war in Russia and Ukraine is raging. You got Iran and Israel. You've still got that stuff hot and heavy. You got all this, but now the U.S. is striking these targets. Not a new thing, but they're pretty actively doing that. They just sent another aircraft carrier over to Asia. So listen, I don't know. I haven't really covered the World War III threats, in a couple episodes, but there's just a lot to think about, isn't there? There's a lot to think about now that we're entering a new year. Pretty soon, Trump will take office and lots of changes will happen, but not all good. So let me just hit that for a quick second. I've studied this a lot, from the tariffs and everything he's proposing, from his cabinet picks that he's doing. Some good, some are controversial, depending on what news station you're following. But all the while, it's change. And change is tough for us to digest, but sometimes good. And I was studying this morning, and I didn't really have anything that I could really report on. I was trying to go back to the Reagan years and compare Reagan and Trump. And there's lots of comparisons, but it's difficult. But the one thing I do want to hit on, and I do want to show this, so I'm going to share my screen here, is when you're comparing the Reagan years with the Trump years, okay, or the soon-to-be Trump years, I think maybe is the best way to say it. It's important to understand that back in the 80s, inflation was double digits, literally like 12%, okay? So interest rates were double digits. Inflation was high. But the problem is, and I just found this article, so I thought some of you would really like this. This is an article that I found in one of my economic newsletters that we subscribe to. This wasn't in the news. But if you're reading this, it says allegedly, it's back down to 3.5 range, referring to inflation. So I want you to all know that tariffs, the Trump tariffs will be inflationary. They will increase prices, which will come off as higher inflation. Inflation right now is not ticking down. It is ticking up. The Fed is continually cutting rates, which they just did a 25 basis point cut. So as the Fed cuts rates, that is basically making money cheaper. And I want to hit on real estate. So if someone on here can just remind me, let's talk a little bit about real estate, because I read a very interesting article this morning about what's going on in real estate. And well, I guess it's good on one end and really bad in another. So I do want to hit that, but I do want to talk a little bit about inflation. Right here, they're saying, if you read the news, listen to the government, 3.5%. That's the range, right? Give or take. That's where it is. But if you go back to the 1980s and how they calculated inflation, this is where it gets really interesting. Stephen and I cover this all the time. But right here, if the government, and I want you to read, I'll read it to you, but I'm just going to kind of go through this. If the government used the same methodology today as it used back in, say, the 1980s, the Reagan years, okay, we'd see much higher rates of inflation. Instead of the advertised 3.5, which is a kind of a fictitious number, a made-up number of, we'll include this and we won't include that. This article says it might be more like 12%. And if you do things like buy a house, rent an apartment, buy a car, pay insurance premiums, enjoy top shelf cut of meat from the grocery store, well, you know what I mean. So what he's basically insinuating here or saying here is that no matter how you're looking at it, inflation is way higher than what you think or what you're seeing in the news. They might report 3.5, but if we'd use the methodology of back in the days of the 80s when inflation was nutty and interest rates were nutty, we're really no different. We're really no different, says this article. And I thought it was very interesting to kind of put that into perspective. So I'll stop sharing my screen on that. But so now that brings back that topic of the Reagan years versus the Trump years. Because when I first started looking at that early this morning, gosh, I was up at like 5:30. I just can't sleep. And I was kind of comparing the Reagan years and the Trump years. And the first thing, it said is the Reagan years were hyperinflation. We were high inflation, high interest rates. And then, now we're on the other side of the curve and inflation's going down, or has been, because of the Fed action, and also interest rates going down. But really, are they going down? Is inflation really down? Well, it depends on how you calculate it, the methodology that you calculate it. And according to that article, no. It's really not. We all know when we go to the grocery store, like, that shit ain't fun. That ain't fun at all. I don't know if anyone has any comments on that. Like, if you've been to the grocery store, I mean, every time somebody on Instagram just said, please shut up. That's interesting. Great way to start the 2025 year. Hey, piss off, buddy. Anyway. Yeah, well, you always got one or two of them coming in, but for the most part, not such a bad thing. So let's keep going on this. The Reagan years versus, the Trump years. There are a lot of similarities. The similarities primarily come to the way that each of those presidents, or each of these presidents, however you want to look at it, view the economy, view everything, and the changes that Trump's going to bring. Here's my best guess. Trump's going to come in and make massive change, which is going to disrupt a lot of things, mostly for the good, but it's going to disrupt the markets too. The tariffs certainly will disrupt the market. So when you're looking at money and you're looking at investing money, all I can tell you is follow the big guys. You have seen in the last quarter of 2024, the big dogs, the Warren Buffetts, the Bezos, you've seen them sell off their positions, take their profits, right? In the end of this year, largely the reason the markets were having a hard time and still today are having a hard time is lots of profit taking. Take a note from that. I had a lot of conversations in the last 30 days with people about what should I do with my 401k? What should I do with my investments? It's been such a good year. Do you think 2025 is going to be that good of a year? Do you think I should just keep riding it out? And I can't really tell people what to do, but I can say, well, just look at the facts, right? Let's lay out the facts and get rid of opinions and emotions. The fact is, we have been in the longest bull run in history. And because we've been in the longest bull run in history, eventually that bull run will run out of steam. So what are some of the reasons bull runs run out of steam? Well, number one, the economy starts to slow down. Well, what slows the economy down? Government, okay, is a big reason, which they've been trying to over the last couple of years because of the inflation. I can't call it hyperinflation, but it was pretty darn close. They were really trying to slow things down. They raised interest rates significantly, which now we're on the other side. They're dropping interest rates, but they're doing it slowly, and they will probably continue, okay, which will maybe kind of restart the engines on the economy. But here's the thing that you're not getting the truth on, and you got to go to economic articles about that, and you're not going to get it in the news. Unemployment numbers are going up. That is a sign of the economy slowing down. So listen, all the facts point to one place. The economy is slowing, which means the markets are going to slow, which is exactly why Warren Buffett is taking profits. There's the lazy cash. He is back at it. He is full of piss and vinegar today. But you know what? Listen, the cat knows it's a new year and he is ready for it. Right, Cashy? You're ready for it. And we got some treats lined up for him. But back to that. So when you're really talking about what should you do with money, well, it's different for everybody. If there's some of you on here watching, you're 30, 20, 30, maybe even early 40s, and you're plowing money into the market and you got time and you're okay riding the roller coaster, well, then just stay the course. Keep dollar cost averaging into the market, keep continually buying. But here's what I always tell people. I say, if you don't really have the cojones, or you don't really have what it takes to hold in there and watch the market that could shed 10 to 50%. I don't know. I can't tell you where, but Paulson saying 10 to 15%. Some of the other economists like Harry Dent are saying up to 50% pullbacks. So if you don't have what it takes to ride that roller coaster, then get out of the kitchen. If you can't handle the heat, get out of the kitchen. So here's what I always tell people. Continue dollar cost averaging in the market, because the best thing that could happen when you're still investing on a systematic level, which means just consistently and persistently putting money in, is the market goes down. Because every time you buy, you're buying at a lower price. Remember, I mentioned that with treasury bonds. All year long, we've been able to buy those things lower and lower and lower. So that's a really good thing because you're buying low. However, what people don't do is they don't take their profits off the table. Institutions do, which is why you've seen the markets falter in December and at the end of the year. It's profit taking, but it's profit taking not from the average person. It's profit taking from institutions and big investors like Berkshire Hathaway, good old Warren Buffett, and Bezos. Okay. And all of them profit taking. But yet the average person doesn't follow suit. The average financial advisor typically isn't advising their client, hey, let's take some of the profits off the table. They just let it ride, because it's very difficult as a financial advisor, which I did for 16 years, to literally manage a large, book of business and do that for every client. But some advisors are, and there are very good advisors that are doing a great job. I know family offices absolutely are taking profits off the table for their clients, but they've only got maybe 1 or 5 different families they're managing money for. So it's a lot easier. So I know I'm going on a little bit of a ramble with this, but it's just logical. If every big institution is taking profits, why are you not? Why are you riding it out? Why are you thinking it's going to go up, up, and up into the moon? And I can tell you why. Because you haven't seen a downside to the market in a very long time. Like when you look at the average person who's investing, I mean, like millennials, let's pick on them for a little bit. They've never seen the downside of a market. I mean, you could argue that during the pandemic they did, but it was like down and back up. If you were sleeping a little bit late one day, you missed it, right? It went down and it went right back up because of the government printing, $5.2 trillion. So you just really, really got to just look at it, decide what's best for you and your family and your investment philosophy. And, well, if it's ride it out, great. I wish you the best of luck. If it's taking profits, well, then get on it. It's a new year. It's time to write your New Year's resolutions. And maybe part of that New Year's resolutions is, hey, it's time to take some profits off the table. Yeah, I would say it is before it's too late, because you can't use the excuse, oh, I don't want to sell because I don't want the tax hit. It's a new year. You got an entire 12-month run to figure your taxes out. So take the profits and call it a day. All right, let's keep going here. I want to get to another article that I had pulled up here. In Yahoo Finance, it said stocks just did something they haven't done in decades, which is interesting. It was just a big shift of money out of the markets into safe assets like bonds and institutional grade bonds or AAA rated bonds. I mean, there was a whole article. You can read that for yourself. But there was another article I wanted to get out here. So we already talked about the attacks going on, the real inflation numbers, the Dow tumbling. Where are we here? When I go into this, I pull tons of screens up. So sometimes I got to go back in and I got to figure out where I'm at with these. So we talked Bitcoin. Let me go to some questions while I'm trying to find this. And I did also read another article. Somebody had mentioned farms. I'm trying to find that. I went to farm school. So Pedro, do you realize farmland is probably one of the best inflation proof things you could buy? No kidding. Like when you look at inflation proof things to invest in, farmland is probably one of the best there is. So Pedro, if you went to farm school, you got to get some farmland, which I'm sure you already have that. All right, I'm going to come to real estate in a second because Pedro had mentioned after January, a lot of houses and cars will be for sale. He's damn right. Pedro nailed it. I will definitely tell you that if you look at the delinquency rates and you look at what's been going on, I've done a bunch of YouTube videos. So if any of you are following me on my YouTube, thank you. Thank you for the subscribing to @the_Chris_Naugle. But also, if you're not, go to YouTube and just subscribe to my channel. It doesn't cost you a darn thing. I put a video a day out. Just every single day I have a new video going out. And I have covered that exact thing that Pedro is talking about, of why there will be a lot of houses and a lot of cars for sale at discounts going into this year, because the delinquencies are high and spiking, because debts are at all-time highs and people are just struggling. As we start seeing unemployment numbers go up, you're going to start seeing what? More houses and more cars for sale. So let me actually just continue with that. I read a whole article. Excuse me, I'm a little under the weather. I read a whole article on real estate, and they just did it, and I can't remember who did it. Somebody did a study, it doesn't matter, but they did a study on real estate. So the good news is supply, like real estate supply, is way up. So it's actually, real estate supply right now is higher than it was in 2020. So a lot of people, that, real estate, it was very hard to find real estate. There was a major shortage in housing on the market, but that is gone now. It flipped. Okay. So now there is a surplus of houses on the market. But here's the problem. The average house is on the market 43 days. So there's two things to consider with that. And it was saying actually closer to 60 days, but 43 was the average across the country. But most houses on the market are sitting on the market for 60 days. Now, any of you that are realtors, you're probably like, oh, no way, houses are selling if they're priced right. So always remember, like when you list a house on the market, it will sell if it's priced right, because people are always looking for a bargain on a house. So if you're pricing your house right, it's going to sell. But a lot of people still think prices, which they are still going up, prices of houses are still going up, but they think they're going to get top dollar. If you got a house or a flip or something that you're trying to sell and you price it like at the high price because you think, hey, this is a great house, I just redid it all, you're more than likely going to sit on the market, and your carry costs are going to eat away at your profits. I did this 274 times and I got it wrong probably 270 times. I always should have priced my houses lower than we did and tried to drive the price higher by demand. And we never did. We priced our houses at the market and then we always dropped price. It was a stupid thing. I learned a lot during those years, but you know what? It's just, sometimes when you get into the house, you just think your house is worth a ton of money. And that's what we're seeing in the markets right now. So supply is up, but average time on the market is way up. Okay. So you got more houses sitting on the market for a longer period of time. And a lot of that study also said there are a lot of houses that just, number one, aren't priced right, but number two, aren't really nice houses. There's a lot of shit inventory on the market, said one of the realtors that was chiming in on that article. So I don't know if any of you have any information about real estate. If any of you are realtors, I mean, there's tons of realtors out there, so we probably have some on here. What are you seeing in your market? Are you seeing houses sitting on the market? Are you seeing prices coming down? Here in Buffalo, which I know it's a very small sample size, we are seeing prices going up, but more inventory sitting and sitting for a long period of time. So let's come over and get to some more questions here before I move on to the next topic. And one of the things I wanted to talk about, well, Jimmy Carter, which, that was, let me get that real quick. Just kind of saw that on there. Jimmy Carter, some of you might not even know who Jimmy Carter is, but he was a president. Okay. And the thing that kind of hit me about Jimmy Carter passing away, and he lived a good long life, is that when I was born in 1977, Jimmy Carter was the president. So it just shows I'm getting older. We all are. I mean, I know we're all getting older. We just turned a new year, 2025, but that was a hard one because, listen, Jimmy Carter, the president that was there when I was born, is now gone. So I don't know. You can take that for what it's worth. But let's see. Anderson DRA said, same here on cold, but we're headed to go make some money. All right. Not really sure what that's relevant or what that was regarded. Let's see. Yeah, just Reagan was an actor. So Pedro is just reminding any of you, if you don't remember, Ronald Reagan was an actor, not a politician. Donald Trump was a businessman, not a politician. So some similarities there. And then Lemney said, how can I get help with the infinite banking concept? That's a piece of cake. You can just go to chrisnoggle.com. Matter of fact, I'll put it in the comments. Let's see. There you go. I just put the link in there. So just click that. Go to chrisnoggle.com or beyourownbanker.com. Be your own bank, be your own banker. We own all the sites. And then just watch the video so that you understand the infinite banking concept. And then once you watch the video, then book a call with our money mentors. And that's how you get started. We'll walk through what it is you're looking to do, what problem you're trying to solve, and we'll build a custom structured policy and system. The IBC is a process, not a product. So we'll build that whole thing for you. So that's how you get started with that. We're going to be covering a lot of that. Again, my YouTube channel, not to keep beating the dead horse, but since it's a new year, subscribe to my YouTube channel. That's I'm not asking, I'm just telling you, please subscribe to my YouTube channel. Just go on there, subscribe. There is so much content, well over 1,000 videos, put a new one up every single day. And also some cool news, maybe relevant to some of you, not to others, but I've got a brand new YouTube channel that we are launching January 15th. So we've been working 6 months now to create the content for what I think is a really interesting kind of way that we're doing this. And it's called BYOP or BYO Porsche. So it's a Porsche channel. So it's not for everybody. If you like cars and you like Porsches, you will love this channel. There are 2 episodes. We will do 1 episode a month. Okay, for now, maybe 2 in some months, but one will be documentary style where we find Porsche owners around here. The last one we just did was a 2019 GT2 RS, which is like full race car, wild car. And we go through with the owner and talk about, their journey, about embracing the journey and chasing the dream of Porsche ownership and how they did it. But not only that, we drive the cars, we talk about the cars. It's pretty interesting. And then the other episode we're doing is completely cinematic. If you like the sound of cars and you like engine noise and mixed with music and cinematography, that's the other one. So get ready. BYO Porsche is launching January 15th. You'll start hearing about it, and you'll hear about it real heavily by February. But just all know, check that out. Subscribe to that channel as well at BYO Porsche. Giving you guys too many little commercials today here, but let's get into this. Dexter said eating less, taking more supplements. So if any of you don't know Dexter, so every time I go to California, I always hook up with Dex, and Dex lost a bunch of weight. And I last time I was there, we were driving back, and I said, "How did you do this?" And he says, "Tea and diet," and he takes this supplement, and I'm like, "That's it? You're not hitting the gym and running 5 miles a day and doing 100 push-ups?" He said, "Nope. I take this tea. It literally, it's just a tea, and it tastes pretty darn good. And then he's got a supplement he takes." So if any of you are interested in hearing how Dexter lost, hit him up. I mean, literally, sounded too good. I thought, listen, when you see somebody that loses a bunch of weight, what's the first thing you think of today? Ozempic, right? I was like, wow, he's taking Ozempic. And he's like, "No, man, I didn't take that. I'm just drinking tea." And I'm just like, that's insane. So, hey, if you don't want to take the drugs, the Ozempics, and you're just looking for a natural way to do it, get a hold of Dex. A little shout out to him. Let's see. Right on. Drew just said my YouTube channel just crossed over the 60,000 subscriber mark. So thank you all. If you are subscribed to the channel, thanks for helping me get there. Wample. I might be saying your name wrong. WMPOL from YouTube said, "Fools are still adding zeros to homes here. 120 day plus is common." So right there saying, the time on market, 120 days. Imagine being a flipper, or just imagine being a real estate investor, and your house sits on the market 120 days. Every single month, you've got carry costs. You've got hard money interest costs. You've got utilities. You got things that go wrong. You got maintenance of the house. 120 days is common. I remember just a couple of years ago, or even maybe a year ago, it seemed like houses were on the market 10 days, but right there. So Christine said graduated from high school in 1977. So Christine's got me beat by a little bit. I graduated high school in 1996. So yep. That's I'm not the old person here, I suppose, but nonetheless, we all remember Jimmy Carter. Peanut Farmer from Georgia, Carlos VF coming in from YouTube. Way to go. I love peanuts. I'm sure all of you do. That's definitely a good industry to be in. Let's see. Subscribing to the BYOP. Thanks, Justin. Yeah. So Eve Page just gave everybody, info. So Eve, connect with Dexter. Dexter, connect with Eve. Steve McCarthy said, so what is better for the return, IBC or money school or doing the lift flip? So I guess I don't really understand Steve's question coming in from Facebook, but you're really not. The infinite banking concept, let me preface, it's a process. Okay. That's all it is. It's a process of taking back the banking function. So here's the easiest way I always explain it is you're not going to compare IBC to, should I put money into, a specially designed whole life that I'm going to use for IBC, or should I invest in the S&P, or should I put money in IBC, or should I put money in the flipping of lifts, forklifts? It's not one or the other. It's one and the other. Does that make sense? So you don't have to make a decision. Do I do the specially designed whole life policy, or do I put money do I buy a lift and flip it, with that program? You don't have to decide one or the other. You do both. That's the whole point, is making money twice on the same dollar. The infinite banking concept allows you to literally take back all the money that you would normally give away. If the banks are making a spread on your money, which they certainly are, you're depositing money in the bank, they're making your money go to work for them, and they are making money on every dollar you leave there. Matter of fact, you know this because if you're at a bank and they're paying you 3%, and you go to take a car loan and they charge you 7%, who's making money? Is it you or them? Yeah, you get it, right? Doesn't matter if they're paying you 3 or 4%, they're charging you 7. They're making a spread. So you do the same thing by using a specially designed and engineered whole life in conjunction with the process called the infinite banking concepts. You are able to basically take the spreads back, and your money continuously and forever will work for you 24/7, earning uninterrupted compounding interest. While then the number one thing with IBC is don't just put the money in the whole life. This is where people make the mistake. Sorry, now you got me on a tangent. This is where people make the mistake with the infinite banking concept. They literally think that all the money's made with the product, the specially designed whole life. So they'll put money into the policy and they won't do anything else. That is, I'm not going to say that's stupid, because it's still better. You're going to make more there. You're going to have a death benefit for your family. You're going to make more than a bank, but that's not how you make money. So Steve, think of it this way. You put money into the policy, then immediately you identify somewhere for that money to go to work. Let's pick on the flipping of the forklifts that I do and a couple other people do. So we put money into the policy. We immediately take a loan from the policy and we buy a forklift. Then 3 months, 6 months, however long it takes to sell your lift, you sell it. You make 20 or 40%. You take the profits and the amount that you took from the policy and you put it back into the policy instead of putting it into a bank account. Because listen, if you're creating your own banking system, why would you ever want to take your profits and put them back into a traditional bank where the bank's going to make money? And you already know that. Why wouldn't you take your profits and put them back into your banking system, which is back into the policy, repaying the loan you took from the insurance company? And that is how you do it. It's a circle, folks. All you're doing is you're just completing a circle, an infinite circle where your money just starts on the left side in the policy, moves over to the right side, which is the opportunity that whatever you want to invest in, whatever you want to do with the money, paying down debt, buying cars, anything. And then you take the money that you would have given away to a bank in a monthly payment or deposits into a bank, and you circle that around the bottom part of the circle and put it back into the policy. By doing that, because your money is earning interest and dividends uninterrupted, if that's the compounding nature, your money continuously keeps to grow, even though you then take it out because you take a loan from the insurance company and you make the money work for you a second time. There's a little bit of math calculation. I teach this in my videos, okay? Because you never want to borrow from the policy to invest in something that is going to pay you less or has the potential to pay you less than what your cost of capital is. It should make perfect sense. How many of you, if you had a home equity line of credit at 8%, would take a loan from your home equity line of credit to put money into a CD at 4%? It cost you 8, but you buy a CD at 4. Would any of you do that? Absolutely not. You'd be like, that's the dumbest fucking thing you've ever said. Excuse my language. Because it is. You would never take it out at 8 and put it into something making 4. You'd be losing 4%. So why would you do that using your policy in the infinite banking concept? If the insurance company charges you 5.2%, which is one of the rates they charge today, then you want to make sure your money goes and it has the potential to make more than 5.2%. It's simple because then you make a spread, but you make not just one spread, which is if your cost of capital is 5.2, which is the interest rate on the loan the insurance company gives you, and you go out and you make 10, okay? You make 10%. You made a spread. You made a nice spread, right? You made a 6.2%, or did I do that right? 5.2, whatever. You made a spread. I'm not in the mood of doing math in my head today. And then your money, all of your money stayed in the policy, earning interest and dividends. And depending on what year you're at in your policy, that number keeps going up because it's just mathematics. I know I went down a rabbit hole on that one, but I hope that helps. And hey, for some of you, that's a good kickoff for 2025. It's just getting back to the fundamentals, back to the basics of what is the infinite banking concept. How can it benefit me? How can it, help me? It's all about spreads. It's all about arbitrage. It's very simple. You are doing what a bank does, but you're not giving up that function to a bank. You're not saying, hey, bank, here's my money. Go make money on it. You're saying, screw you, bank. I'm going to control my money. I'm going to put my money into my own banking system, and I'm going to make the spread, not you. Does that make sense? So many people get hung up on the thing. They get hung up. Why would I put money in a policy and then have to pay an interest rate to use my own money? Because it's no different than what you're doing today. You're putting money in a bank account where they're paying you barely any interest on your money, and then you're borrowing money from the bank at a higher interest rate. Who's the idiot here? I'm sorry, but you get my point. Like, it's the same thing you're doing today, but you're taking the control of your money back, and you're becoming the banker. You're applying the banking functions in your life, not giving it up. That's all it is. Steve, hopefully that helps. Sorry, I went down a rabbit hole for some of you. Some of you are like, holy crap. Yeah. Like, thank you so much. Somebody said, you are so practical. It's not me being practical. It's just logical. It's just mathematics. And thank you for giving me the credit about being practical, but like, don't give me that much credit. It just makes mathematical sense. Everybody can articulate it because you're doing it every single day. You're just giving the functions away to the wrong people, the banks. You don't need to make the banks any more money. You need to make yourself more money. You need to make your family more money. So just control your money and practice the infinite banking concept. 1,000 videos on my YouTube channel teaching you how to do it in so many different scenarios. And just jump on a call with us and we'll walk through how it works. We'll show you the mathematics. Like, I got to show you this. This is, I'm not going to show you the name, but this is a proposal that we just did for somebody. I got to meet with them tomorrow. They're a friend of mine. But what's so unique about this is their need was so simple. So I'll kind of just give it to you. And this is kind of what we do for our clients. They had a windfall of money. Okay. A relative passed away and left them an inheritance. And they've got a car loan on a really nice Cadillac Escalade. So what I basically said to him, I said, hey, you want me to show you how much money you're giving away on that Escalade? So we did the math and we ran the math on a 72, I did a YouTube video on this, but we ran the math on a 73-month note that car loan that they took out on that Escalade. And folks, a lot of you, this is gonna really, really hit home for you. 73 months. So they bought the vehicle. I think it was like $150,000, but they end up paying $203,470 for that Escalade if they make every payment. Now, very few people keep a car the entire period of time, but they still lose money. So that means the total interest that they paid was $44,470. Just think about that. One car financed, now it's a nice car, financed with a bank, cost this couple $44,000. And all I said to him is I said, hey, how about without changing anything in your life, except for where your money goes first, instead of giving $44,000 away, how about we put $44,000 back in your bank? Okay. Would that make sense? And they said, you're joking, right? And I said, no, I said, it's so simple. You are giving away $44,000 today, but what if you kept the $44,000? So here's what we did. We said, here's how we build it. We're going to design a policy, a specially designed and engineered whole life policy where you're going to put the money from the inheritance. Because where's the money from the inheritance sitting now? In a traditional bank. maybe making 3%, maybe not even. That's where it's sitting. Okay. They might need the money tomorrow. They might not. They're business owners, but that's where it's sitting. I said, change where that money sits. Let's put it into the policy. So that's all we did. We moved that money, not all of it, but we moved a chunk of that money to the policy. Now, here's how this plays out. We put the money into the policy. We immediately take a loan from the policy and pay the Escalade loan off. Okay. So no longer do we owe any money to the traditional bank. However, we continue to make monthly payments just like we were before on that Escalade for the exact same dollar amount, but we make those payments back to the policy. So nothing changed. For this couple, it is literally a complete mood point, like, or however you want to call it. They don't change anything in their life. They've got the money right now sitting in a bank account, and they're making car payments on the Escalade. So all they do is they change where the money sits. And instead of sitting in their bank, they put it into a policy, which we're going to call their instead of keeping it in a conventional bank, they're going to put it in their bank. And then they're going to take the money out of their bank and pay off the car loan and make the car payments back to their policy. Now, here's the impact. How long does it take to pay off third-party debts? Obviously, within the first month. Let's see. The total amount of time it takes to 100% pay off the loan is no longer 73 months because of uninterrupted compounding interest. It only takes them 64 months. So almost 9 months saved in interest payments. Okay. So they only have to make 9 months less payments, but all the money is going back into their policy, which means they get all the money back for the car that they bought. So here's basically what it works out to be. Total payments made. This should blow your mind. $160,124. Okay. Total interest paid, because now only interest we're paying is the interest to the insurance company. That is $21,972, not $44,000. So we give up $21,000 instead of $44,000. But wait, you didn't give up $21,000, because now at the end of that period of time, you have $456,408 in cash value. Let me pause. Does that make sense? Every payment they are making on that Escalade to the conventional bank today is money that's gone. They never get it back. Every payment they make under this new program using the infinite banking concept is money that goes into their account. The car payments now become their money again, not the bank's money. It's their money. They keep it all, which is why, like, we lay it out because I want people to know, like, yes, you're still paying interest, $21,972. That's what the insurance company took. But your policy earned more interest and dividends than what you ever paid them. And you paid interest back to yourself at the same rate you're paying interest to a third-party debt. So when you look at it, avoid paying an additional $22,498 in interest payments to a third-party creditor. After paying all debts in full, you'll have approximately $456,000 in cash value to use again, because you controlled all the money. After paying all debts in full, you have approximately a $7.4 million death benefit to protect your family. And they have beautiful kids, 2 kids. Okay. And after paying all their debts in full, that you have $2,825.98 in extra cash flow that used to go to the car payments in less time. Okay. And after paying all debts in full, you have $159,000 of debt out of your life. That's it. This is a big proposal just because we ran lots of different scenarios for them on how it works, but like the scenarios are always the same. It's always going to work the same. I just wanted to kind of lay that out. I know I went down a rabbit hole. You guys are here to hear the news, but there's just not a lot of good shit in the news. It's boring. It's the first day of the year. Most people are sleeping, for crying out loud. Oh, you know who was also sleeping? Puerto Rico. They don't have any power. Most of Puerto Rico was without power on New Year's Eve. All right, so let's see. Any questions come in on that? Nothing on Instagram. A lot of people wishing me a happy new year. I don't like to call it a happy new year. I like to call it a happy new morning. That's what I've been calling it today. I don't want to think about a new year. I want to think this is just a new morning. Let's take it day by day, minute by minute. Let's live in the present. Let's see, for IBC loan people. Yeah. Steve McCarthy said the same thing. You can take money from the policy and lend it to people on Private Money Club at 12% and do the same thing. Take the interest from the 12% that the borrower pays you, put it back into the policy. Identical. You're making money twice on the same dollar. That's the whole idea, because you're not giving any money up. You're giving interest to the insurance company, but the insurance company is paying you interest and dividends on the money, even though you're using the money. So over time, the compounding, usually in the first 2 years, sometimes first 3 years, you're at a loss. I tell that to people all the time. I'm like, you're going to lose money with this program for the first 3 years. But are you willing to give up 3 years of interest to make money for the rest of your life without working any harder, longer, or taking on any risk? That's really what it is. Snap Clip from YouTube said, if front loading a policy, how much can you borrow back and how are payments determined? Here, let me just give you a real example. That's a great question. So I'll go back to this proposal, and I'll just kind of go into one of the policies that we designed for them. Hang on one second. All right. So let's see, who was that? Snap Clip was asking front loading the policy. So this particular example showed them, and again, they have an inheritance of $270,000. Is the amount they're going to front load into the policy. So they're going to put $270,000 into the policy, and then an additional $30,000 over the next year. And every year they want the ability to deposit 30 grand. So everybody following? So year one, they put in $300,000 into the policy. Now, this is just their example. I'm just using it. How much money do they have access to immediately in the first year? Or you could say immediately in the first 30 days, but the number would be a little different. 92.8%. So out of the 300, they get to use $278,403. Okay. That's how much they get to use in that first year. The second year, they put $30,000 in to the policy. Now let's just use this example. They put 300 in. Let's say they took 278 out and they did something with it to make more. The next year, they put 30,000 in. How much money of that 30,000 can they use? 38. Because of the compounding on the 300,000 they put in. So they're earning interest and dividends on all of that 278,000 that's in there that could be used in the cash value, except for that money has already gone out making 10, 12%. So the next year they put 30 in and they can take out 38. The next year they put 30 in and they can take out a little more, 38 and even higher change. The next year, the fourth year, they put 30 in and they can take 40,000 out. And then it goes 42 and 43 and 43 and 44 and 52. Every year, you're going to have more money than you did the year before. And that has nothing to do with me being smart, nothing to do with us stumbling on anything. It has everything to do with math. That's it. This is just math. All right. So sorry about that rabbit hole, but hopefully that helps some folks. Snapchat talked about the front loading. So up here, Hindle Go Insurance. Hopefully I said that right. The Private Lending Club. So PMC, as we call it, is just for business owners. No. So you can be a lender as an individual. The only side that needs to be commercial or a business is the borrower, because as regulation works, a lender can only lend to a business. Otherwise, you got all sorts of Dodd-Frank rules and that. So the question was, is it just for business owners? Absolutely not. But if you're a borrower on Private Money Club, you have to be borrowing in the entity's name, in a company name. You can't borrow personally for your primary residence. That is definitely not allowed. But if you're a lender, like if Chris Noggle went on Private Money Club today, I could lend Chris Noggle to XYZ LLC. That's fine. A lender can be an individual, but a borrower needs to be an entity. Hopefully that clears that up. All right, let's see. Do we have anything else here in the final few minutes that we've got for the first episode of 2025, where I don't have Mr. Stephen Nagy with me today? He's texting me earlier, so he is up and moving. But I had one other thing I wanted to hit. U.S. Treasury is right now dealing with some hacking. So they had a persistent hacking threat, stupid, useless knowledge, trying to find some other things we can talk about. But I got one other one here I want to read for you. Where is it? We got all the pardons. Oh, let's see. I already talked about the Santa Claus rally. Puerto Rico being without power. hell, the rest of it is just boring news. Nothing even worth talking about. Final thing in New Orleans. It's funny. Last night we were talking about Bourbon Street. Have any of you ever been to Bourbon Street, like in New Orleans? It's a only way I can describe it. It's a fun place. It smells. If I could ever just envision what hell would smell like, I would have to envision hell smells a lot like Bourbon Street. Any of you relate? Any of you been on Bourbon Street? That stench in the air that is kind of a mix of puke that's probably a year old and sewer mixed. It's almost like they take puke and sewer and mix it up in a big pot. That's sort of the smell. But anyway, that's not the reason I'm talking about Bourbon Street. Is yesterday during the ball drop, the New Year's Eve party, a car slammed into a crowd of people, and there are a whole bunch of people that didn't make it. So that's a tragic event that happened over there on Bourbon Street, and they still are kind of trying to figure out what's going on there and what happened and what caused that. Was it an accident? Was it intentional? And the other thing they're still trying to figure out, and I always hate talking about plane crashes because I fly so much, but out in there was a 737, if I'm not mistaken, that was coming in for a landing in Korea or North Korea, it might have been. And supposedly it was a bird strike, and the plane hit the runway. It didn't have its landing gear out, or maybe it slammed into the runway and the landing gear broke. So the video footage, it's terrible to watch. You see the plane skidding down the runway, sparks and everything flying, flames flying. But then at the end of the runway, because they couldn't stop it because it didn't have wheels, it was just sliding on its belly, which, listen, like usually when a plane lands on a runway without landing gear, if the plane stops, there's usually, some bumps, some bruises, but casualties are usually minimal, if any. This plane was skidding down the runway, and at the end of the runway, there was a giant concrete wall, and the plane slammed into the wall. I think there was only like 3 survivors, and there were people that were in the tail of the plane, which, obviously when the plane hit, it just imploded and the back part of the plane broke off. I don't know if any of you saw it, but it's just a seriously sad situation. But, we really got to figure out what's going on. And, in this modern age with just technology where it's at, how are we still dealing? And I'm not a pilot. I'm not, anything like that. So I just don't know what I don't know. Some of you do, but how is it that a bird can take a plane down still? Why haven't we found a way to make it so that when a bird goes into the engine of the planes, it doesn't destroy the plane? Now, I know this plane was descending, so that's probably the worst time to hit birds, either when you're taking off or when you're ascending and getting ready to land. But it's just a sad thing to see. Sad thing. Anthony Crawford said, no incident is like the show Mr. Mercedes. Not sure what that is. It's been a hot minute since I've been there. Yeah, well, I'm glad you weren't there last night. Let's just put it that way. But with that being said, folks, let me see. I got a couple things up here on Instagram about the smell, not the tragedy, of course. Prayers to those involved. Yes, exactly. I started the Bourbon Street thing just with that stench, and then I moved into a totally different topic. So I should have done a better job of transitioning. So the stench, yes, that's one thing, but the tragic event, prayers to all those in the families, of those that didn't make it through it. Let's see. What do you think of using dividend payments from the carrier to purchase PUA insurance? So yeah, insured by mail or insured by May, whatever that is. Yes, every policy we design, the dividends that are paid every year, the policy year from the insurance carriers, we put them into PUAs. So that's just part of the specially designed and engineered structure we do. Every time a dividend is paid, it goes into paid up additions, creating more cash value, but also increasing the death benefit and increasing the coverage. So that's how we do them. There's a lot more to how you design them. But again, if any of you wanted to know how we design the policies, I'm very transparent. A lot of people, my peers in the industry, were pissed that I put these videos up because I kind of peeled the curtain back and showed everybody, hey, here's how we design these policies. I've got a video on YouTube, so make sure you subscribe to my YouTube channel at The Chris Naugle, and it is how to design an IBC policy. But make sure you watch the updated version because there was a change in 2022, 7702. So you want to watch the updated. But I go through, I think, 5 different plan designs that we use. No one policy that we design is ever the same because no one problem that we solve is ever the same. We have just literally found a way to template some of the plan designs so we know what ones work best for certain circumstances versus others. So that's what we've done. So you can certainly learn that on on my YouTube channel and learn a whole bunch more. Our Hispanic community needs to understand this concept. For yesterday, yes, you are absolutely correct. There are a whole bunch of people that we work with in the Hispanic community that are out there doing a fine job of teaching people the infinite banking concepts, using the late R. Nelson Nash's teachings and my teachings as a catapult to kind of bring this to the Latino community and in the Hispanic community. So that is already there. They're not hard to find. You can go to my Instagram. They're always posting on there. But yes, we are trying our best to get as many boots on the ground to serve the Hispanic community and Latino communities, because they absolutely need to learn how to take back control of their money and take back the banking functions in their life. There's no reason we should be giving all that function over to the banks, because the banks are not there to serve you, to do good by you, to help you and your family. They're there for one reason, and that is to profit. And that's what they do. So flip it around and do what they do, and just do it with your own system. So Dexter's asking, are we doing a wealth webinar today? No, we are not. So this is going to be the only show today, unfortunately. I've got meetings this afternoon that will make it so I cannot do wealth webinar, but everyone should know that every single Wednesday, we do 3 shows. We do WTF, this show, which is the first episode of 2025. I was honored to be able to do this on the first. We also do wealth webinar every Wednesday, which happens at 1 p.m. Eastern. You can register by going to chrisnoggle.com, and that first one will be next Wednesday. And then we do Ask Me Anything Happy Hour, where the whole team comes on, answers questions for every single one of you. And how you get to be part of that is you join my YouTube channel by subscribing and click the little bell so it notifies you when we go live, which is every Wednesday, 4:30 Eastern. We do 6 shows every single week, totally free. So make sure you get around this campfire, and it will start to change your financial future. With that being said, folks, thank you so very much for joining me for the first episode of the new year. And with that being said, folks, we will see every one of you in the near future, and we will hear and talk to all of you soon. So with that, thanks for joining me. See you next time.